This video was brought to you by Morning Brew. Hi, welcome to another episode of ColdFusion. William Shakespeare once said, "No legacy is so rich as honesty." 500 years later, it appears that there are many who fail to understand this. If honesty creates legacies, then dishonesty destroys it. The story of Worldcom is about destroying a potential legacy with pure dishonesty. Worldcom was a US telecommunications company who provided phone and mobile services. Valued at over $100 billion, they were one of the largest companies in the world at the time. So how on earth do you destroy a $100 billion company in a matter of months? In this episode, we'll take a look at the lies, deceit, and greed that made this feat possible.
You are watching ColdFusion TV.
The story began in 1983 when the breakup of AT&T left a gaping hole in the long-distance telephone market. Sensing an opportunity, a group of men met at a coffee shop in Jacksonville, Mississippi. What would come out of this meeting would later become Worldcom, but was first incorporated as Long-Distance Discount Service. For simplicity's sake, we'll refer to the company Long-Distance Discount Service as Worldcom in the early days. One of the men in the meeting was Bernie Ebbins, a stern man but hard worker. And at this time, little did he know that this small venture would later make him one of the highest paid executives in the United States. There'll be much more on Bernie later. In 1995, Long Distance Discount Services would officially be renamed to Worldcom. The company's business model was simple. Worldcom didn't build landline cables or cell phone towers, but would instead rent out this infrastructure from other companies. This expense was known as line cost, a point that will be vital to the understanding of the crux of the story, so keep that in mind. Using this existing infrastructure, Worldcom would then provide cell phone and landline service to customers at a discounted rate. The income from customers would hopefully be enough to offset any expenses. The company's initial years were a bit rough. Till 1985, they made losses repeatedly. As the company went into a debt of $1.5 million, the owners decided to hand over the reins to Bernie Ebbins, making him both the president and CEO. Bernie was somewhat of a nobody before getting into the telecom business. He was a former high school basketball coach who later cut his business teeth in the motel business. Bernie was well known to save every penny he could at any chance he got during that time. He personally would clean all the motel rooms and wash the bedding instead of paying someone else to do it. Now the CEO of Worldcom, he was ruthless in his efforts to gain profits and started controlling costs immediately, even to the point of stopping the company's free coffee policy. Despite maybe going a bit too far, his efforts ensured a revenue rise within the first few months of him taking charge. In 1986, revenue rose to $8.6 million, and a year later grew to $18 million. In spite of this, competition in the market was tough, with multiple companies providing similar services. To grow more rapidly, Bernie started following a different strategy. Worldcom either acquired regional rivals or merged with other companies. Over the next 10 years, Bernie purchased 30 companies. The company was officially named Worldcom in 1995, and saw its sales reach nearly $1 billion. Worldcom's largest merger took place in 1998 when it merged with MCI Communications, a company 2.5 times its size. The $37 billion merger was finalized on September 15, 1998. It was the largest company merger in history at the time of its announcement. The company was renamed to MCI Worldcom after this. Worldcom CEO Bernie Ebbins became somewhat of a Wall Street renegade hero with his casual dress sense and salesman attitude. By the year 2000, Worldcom employed 88,000 people and owned 60,000 miles of telephone line not just in the US but around the world. Its revenues were to cross $40 billion and the stock was flying. Bernie by now was receiving $27 million in Worldcom stock options. To fund a lavish lifestyle, he would take out loans from JP Morgan and secure them with Worldcom stock. According to CNBC, a total of $408 million was taken out to buy yachts, then a yacht building company, and not to mention the largest privately owned ranch on planet Earth. Around this time, Worldcom was already in the process of completing a merger with Sprint Corporation. This was supposed to be the biggest merger in history. The $115 billion deal was going to establish Worldcom as the world leader in the industry. The deal, however, would be blocked due to antitrust objections.
If this deal were to go forward, consumers and businesses would pay the price because competition would be reduced in many important telecommunications markets.
The genesis of the Worldcom fraud lay in the failing of the Sprint Corporation acquisition. This essentially exhausted all options of growth through mergers and acquisitions. As mentioned in the beginning, it was a strategy that the company had followed in the 90s to grow rapidly. By the late 90s and 2000, the competition in the market became too intense and it became increasingly difficult to grow through the acquisition route too. Even though the internet was just getting started, it seemed that the long-distance telecommunication cash cow was drying up. Being in the infrastructure game wasn't as profitable as it once was. The telecom industry was hit hard on Wall Street, and Worldcom stock went from $62 a share in 1999 to just $18 a share in the year 2000. Despite Worldcom being a massive player, things were looking bad, so they got desperate. Late in 1999, head accountant David Myers brought in some financial earnings paperwork to Chief Financial Officer Scott Sullivan. Sullivan looked at the papers and said, "There must be a mistake. This couldn't be right, as company profits were down the drain." He asked David to go back and check again. He did, and the accounting department came back with the same number. Scott, annoyed by now, asked David to check another time. He did, and he came back with the same number. This wasn't good. Worldcom was a public company, and the earnings report was due soon. Scott Sullivan, being the CFO, still insisted that the numbers must be wrong. He directed Dave Myers to write down financial entries to make the numbers what he thought they should be. It will all be fine in the end because the pair would figure out the problem by the next earnings release. But when the next quarter came around, David was instructed to repeat the same fraud again. And in the next quarter, he was asked to do the same thing.
The real pressure that the accounting department was put under was producing an entry that was based on the CFO's thought process of what he thought the number should be as opposed to what we knew the underlying answer was.
On realizing that just making fake entries wasn't going to be enough to make the margins look impressive, CFO Scott Sullivan asked David to do something drastic. He would take the costs of renting cell and landline infrastructure and book them down as assets. This was to make Worldcom appear financially healthy. So what exactly did booking infrastructure renting costs as assets mean? Well, an asset is something that a company pays for that will give a future economic benefit. To understand the difference more, let's look a little deeper. Assets are the resources available to a business, whereas expenses are the resources consumed while running a business. Assets are reported for a specific date on the balance sheet, while expenses are reported for an entire accounting period in an income statement. Writing down these line rental costs and infrastructure costs as assets that would generate revenue was illegal. According to internal auditor Glenn Smith, instead of expensing the cost of infrastructure rental at a monthly basis, they were taking those costs and moving them to the balance sheet, where they would be expensed over a 10 to 15 year period, so this makes the costs appear lower per month. This in turn would make income look much better when viewed on a short-term quarterly basis. It wouldn't be long before Worldcom internal auditors noticed something strange in the accounting books. It would spell the end for one of the biggest American companies. The fraud was unearthed by Worldcom's Vice President of Internal Audit, Cynthia Cooper, and also Glenn Smith. Cynthia's suspicion first arose when she came across the term prepaid capacity. This was during a meeting with Corporate Finance Director Sanjeev Sethi. Cynthia and Glenn inquired about what the term meant, but nobody seemed to know, including Sethi himself. Cynthia started pursuing the financial entries made under the term, and in the company's accounting system, she discovered $3 billion of bogus entries, all on the company's balance sheets. She then questioned Scott Sullivan about it during a meeting. Sullivan stated that prepaid capacity was the cost of leasing fiber optic lines that were being underutilized. The idea was that these purchases would yield income as the internet increased in popularity. However, Cynthia was not convinced that these needed to be booked as assets instead of expenses.
Remember, this is during the dot-com boom, and we purchased all that anticipating that all of that capacity would be grabbed. I mean, it would be gone by the time we had bought it. And so when the dot-com bubble burst, those were what's called dark fiber, so there was no traffic on those. And so all of a sudden, now we were locked into these 3-year leases where we're having to pay monthly on those, but we've got no revenue to offset those. And so, as Scott explained it, so really what he was saying is that's really capacity we've prepaid for that we anticipate at some time we'll have traffic for. So it's really an asset of ours that we're going to go capitalize on the balance sheet. So fantastic business case, and if you explain that to somebody off the street, they would say, okay, that makes sense.
I was convinced.
But GAAP says you can't do that, right? And so Cynthia and I left that and both just sort of looked at each other and said, did we hear what we thought we just heard?
It wasn't easy for Cynthia. Attempts were made to discourage her from pursuing the matter. Scott Sullivan once called her on the phone while she was at a hair salon, only to tell her not to discuss the matter with Anderson auditors. Pursuing it further, she started interviewing the accountants who had made the entries, only to discover that they didn't know why those entries were being made in the first place. They were just doing as they were told by their seniors. Before we continue, I just want to take a quick second to thank today's sponsor, Morning Brew. So what do you usually do when you wake up in the morning? Probably pick up your phone and browse aimlessly. But what if you could get up to date with all the latest news in just 5 minutes? Morning Brew is an online newsletter that's sent to your email inbox from Monday to Sunday, and it does just that. I was just reading about the inflation rising in the United States, and how the skyrocketing price of lumber alone is causing home prices to jump by $36,000. If you're interested in business, finance, or tech, subscribe to Morning Brew. It's completely free and takes less than 15 seconds to subscribe. Click the link in the description below to get started. As Cynthia's investigation continued, David Myers would admit that the entries were made up, but Scott Sullivan, however, defended the fraudulent entries. The audit committee asked KPMG, an external auditing firm, to conduct their own review. KPMG asked Sullivan for an explanation. He couldn't give a satisfying answer. Meanwhile, Bernie Ebbers, who was now one of the highest paid executives in the country, continued painting an optimistic picture for the stock market. All the while, he was busy building and protecting his own personal financial empire. He continued to feed Wall Street expectations of double-digit growth.
Is Worldcom a financially sound, solid, surviving company?
Absolutely. We are free cash flow positive. We announced that today.
As the telecommunications industry was shifting and the Worldcom stock began to plunge, the banks now wanted their money back from Bernie. Remember, he had secured loans with Worldcom stock as collateral. To avoid Bernie selling the stock and spooking the market, the Worldcom board of directors gave him a $408 million loan. On April 29, 2002, Bernie was asked to resign due to his personal loan problems. On June 25, 2002, the Worldcom board makes the decision to go public with the investigation. Worldcom would fire Scott Sullivan and David Myers would resign.
Thank you for having me.
What do you want to say to the shareholder out there that's holding WorldCom that just got the news that the SEC has conducted an informal inquiry?
It's a very difficult thing to know what to say because I don't have enough definition to what they're asking. It was not anticipated. It's a very time-consuming prospect because they ask a lot of information. But the thing that I feel very confident in my heart of hearts is that there are not issues that our shareholders ought to be concerned with respect to the investigation by the SEC. I would be the first to tell them if I thought there were some issues.
Worldcom announces that it's going to revise its financial statements for 2001 and the first quarter of 2002. It confessed that it had discovered $3.8 billion in fraudulent entries. As the investigation continued, still more bad news came. Earnings from the years 1999, 2000 and 2001 each had misclassified expenses as assets. The total fraud would measure $11 billion. This led to one of the largest public company accounting frauds in history coming out into the open. With the scandal just breaking 1 year after Enron, American business clearly had a problem. To avoid bankruptcy, Worldcom immediately laid off 17,000 employees. That was equivalent to 1/5 of the workforce. This couldn't save it though. Worldcom, along with all of its active US subsidiaries, filed for Chapter 11 bankruptcy. With $107 billion in assets, it was the largest bankruptcy at the time. However, the company did rebrand itself as MCI to salvage the blow to its reputation due to the fraudulent Worldcom. This new company was bought by Verizon in 2006 for $8 billion. Though investors in Worldcom were unfortunately hit the hardest in the scandal. The New York State Common Retirement Fund, which is one of the largest public pension funds in the US, lost over $300 million. And as Worldcom stock fell off a cliff, investors collectively lost $30 billion. On March 24, 2004, charges were filed against the main actors in Worldcom. In the legal case, the prosecution stated that Bernie was motivated by greed. His wealth was in Worldcom stock, and he had to keep that stock high at all costs. Bernie had financial targets and asked the CFO to meet these targets by any means necessary. But others would argue that Bernie knew nothing of the fraud. The judge didn't agree though, and by the next year, he was arrested. CFO Scott Sullivan and David Myers were handcuffed in New York and paraded in front of TV cameras. In 2005, David Myers was sentenced to 1 year in jail, while Sullivan was given 5 years. Disgraced CEO Bernie Ebbins, under whose leadership the fraud took place, was charged with security fraud and conspiracy. Bernie pled not guilty, but the charges were proven and he was given a sentence of 25 years. He was released 12 years early in December of 2019 due to his poor health. He would die shortly after his release in February last year. The SEC investigation concluded that, quote, Ebbers was aware, at a minimum, that Worldcom was meeting revenue expectations through financial gimmickry, end quote. In 2009, Time magazine named him the 10th most corrupt CEO of all time. The Worldcom fraud is interesting, because despite its severity, it was pretty simply done by misclassifying and incorrectly reporting numbers. It didn't involve Worldcom's network, its technology, or its engineering. Most of the workforce at the company didn't even know that it was going on. Only those at the helm of the company's finances knew what was really happening. Even the board of directors were not aware that a fraud this massive was being conducted right under their noses. As per the investigation by the SEC, the fraud continued this long because of the lack of courage to blow the whistle on senior officials. It's amazing how such things can go unquestioned in such a large company because everyone expects that the person above them is doing the right thing. Today I wonder, are there any future Worldcoms out there? So what do you guys think? Let me know in the comment section below or head over to the Discord for discussion. In the next episode, we'll take a look at the Archegos scandal, where $20 billion was lost in 2 days. If you want to get notified when that video comes out, make sure you're subscribed to ColdFusion. Alright, so that's it. My name is Dagogo, and you've been watching ColdFusion, and I'll catch you again soon for the next episode. Cheers guys, have a good one.
ColdFusion. It's new thinking.